Is this the beginning of a shale crisis? American Petroleum Institute reported late Tuesday that U.S. crude supplies fell by 7.9 million barrels of oil. Okay, and that's quite simply because shale output is starting to decline. Why? Banks are cutting their lending to struggling U.S. shale drillers, another blow to the industry that has long been dealing with a questionable business model. Banks are restricting lending and revising their estimates on the value of some shale reserves. According to the Wall Street Journal, even the largest banks such as J.P. Morgan Chase and Capital One Financial Corp are expected to cut their exposure to the shale industry. Sources told the Wall Street Journal that banks are growing more concerned that if drillers go bankrupt, their assets, the value of which could be declining, may not cover the outstanding loans. I could have told you this without spending millions of dollars on research. The scrambling among big financial institutions comes at the industry is being hit by a wave of write-downs. Chevron said earlier this month that it expects to take a $10 to $11 billion write-down, largely the result of weak assets. Yes, I know. Roughly 200 oil and gas companies have gone bankrupt in North America since 2015. According to Haynes and Boone, more than 30 bankruptcies have occurred in 2019, the highest number in 3 years. Energy companies accounted for 90% of the defaults on corporate debt in the third quarter. 90% of the defaults for the banks are from oil companies. Okay. Now here's the problem, guys. Now these are this red line represents current crude oil prices. Okay, as you can see here, we're in the 60s. This blue here accounts for shale output. Okay, producing less than 6 million here, and we get up as high as 10 million here a day. And this orange is conventional oil. Okay, you don't use fracking for conventional oil. Okay, now as you can see here, we're over $100 a barrel in 2011. In 2012, we're over $100 a barrel as well. And so it kind of goes up and down. And then we have this major drop. We go from $105 a barrel down to 50 something. Okay. And that's because shale output continues to grow. We take a little dip here. Shale goes up and it's starting to come down again. Okay. And so as it's very simple, the graph clearly illustrates that as shale goes up, crude oil prices go down. And this is called economic warfare on OPEC, on Saudi Arabia, because 100% of the terror in the Middle East is funded by oil. And so Donald Trump's plan was to keep it down here. And so we started exporting and producing as much oil as we could thanks to shale. But the problem is it's unsustainable. And banks are shutting the door to shale. So what do you think is going to happen here in the next few years? You're going to see this number drop, and you're going to see oil prices come back strongly. Okay. Oil prices tick higher after U.S. report shows 7.9 million drop in crude inventories. What that tells us is that we're seeing less output. The output is dropping, and it takes a few months to catch up to the reports. But this speaks volumes. Okay. Crude oil prices edged slightly higher on Thursday after the Christmas holiday as a weekly inventory report indicated a bigger than expected decline in stockpiles for oil. American Petroleum Institute reported late Tuesday that U.S. crude supplies fell by 7.9 million barrels of oil for weekend December 20th. According to sources, that was more than analysts' consensus, I can't even say that word, expectations for a draw of 1.83 million barrels, according to Reuters. So, bottom line, we're having to tap into our reserves because we're not producing as much oil as we should be. Okay, bullish sentiment keeps oil above $60 a barrel. So there's a lot of information here I like to go over. If you look here, West Texas Intermediate 60.83, Brent 65, natural gas. So here's a rig count: 685 for oil, 125 for gas, 813, a total of 1,080. Okay, so we are down several rigs from where we were last year. And if you look here, November 6, 2018, we're just under 1,100 rigs here. And here we are, 11.6 at just over 800 rigs. Okay, so that's roughly a difference of 300 rigs there that we're down from a year ago. And if you look here, rigs per basin, there's a lot of numbers there. And so I wanted to get down to here. Permian shale wells are producing a higher gas to oil ratio than expected, another blow to shale drillers. So as they've already developed all the sweet spots in shale, okay? There's money in oil, and natural gas, there isn't near the upside as there is in oil. And so as they pump more water into the structure, it's changing the output. The algorithm doesn't work near as well when you're not in the sweet spots and you continue to keep pumping water into the structure. And so they're not getting the same upside returns as they once were before. So it's not only are they reducing the amount of shale they're developing, each shale well is not as economically feasible as what it was in 2012. Bank lending to Permian slows, lending to oil companies in the Permian slowing. As banks seek to reduce their exposure, some banks are growing more concerned that the reduced value of shale assets could fail to cover for missed debt payments. So not only are these banks not making money in shale, they're also reducing the value of shale assets based upon the fact that they're producing more gas and they're producing more water in the well. Iraq to cut 110,000 barrels of oil per day, so they're complying with OPEC. I found this interesting. This is an interesting article, and as I was reading it, I already knew it was BS. But then once I realized who the editor of the article was, then I realized how much BS it was. 100% of renewables would cost $73 trillion, pay itself off in 7 years. A new Stanford University study finds that phasing out fossil fuels would cost the world $73 trillion, but would be an offset by $11 trillion in annual savings over 7 years. The savings would offset the cost. There's really no downside to making this transition, the study author Mark Jacobson, remember that name, told Bloomberg. So it sounds like, this is what I'm hearing every day in the liberal news. And so I looked up Mark Jacobson. Okay, so here he is right here. Look at that beautiful face, Mark Jacobson. Give him a call. Here's his phone number. Tell him he's an idiot. And if you look here, and sorry, I don't think he's an idiot, but anyways, the individual state roadmaps were the primary scientific justification for laws in the 9 U.S. states, the District of Columbia, Puerto Rico transitioned up to 100% clean renewable electricity, blah, blah, blah. Primary scientific justification behind the U.S. Green New Deal, House of Senate resolutions, blah, 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 along with the House. So he is a major contributor to the U.S. Green New Deal. What does that sound like? Yeah, this is all liberal mumbo jumbo pushing their agenda. Look, I'm telling you right now, that $73 trillion would be wasted. Okay. And first off, that's never going to happen. The government's never going to issue $73 trillion to develop green energy. Do you remember how they laughed, what's that lady's name, off the stage when she started talking about the Green New Deal? It ain't happening, okay? I don't even know why they put it out there. Energy equity insurance dries up. The amount of stocks sold in the energy sector plunged by 70% this year, falling to just $1.3 billion in debt. Issuance was flat. Investors have spurned the shale industry. It seems to be fairly unloved as a sector. So bottom line, the amount of money that's being invested into the stock market for the energy sector has plunged tremendously. So not only are banks shutting the door to shale, investors are doing the same. And so what this is going to do, guys, what you're going to see here. So oil prices have dropped tremendously because of the growth of shale. But as you start to see shale drop, you're going to see oil prices continue to rise. As you can see from here to 30 to 60 something dollars a barrel, we're going to see the rise continue. Right today, we're at 61.75. Okay, oil prices continue to grow. I focus more on conventional oil plays, and in conventional oil plays are what was profitable back in 04 when oil prices were $40 a barrel. When in 2005, when oil prices hit 50, we thought we won the lottery. And so today they're 62. And the reason why $62 oil and people are crying about low oil prices because shale is very expensive to develop. But the shale is going to start to decline in a big way, and oil prices are going to continue to grow. I'm Sean Pruitt, president of Kingdom Exploration. If you guys ever have any questions, give me a call, 307-622-1645. You could please subscribe to my channel if you like these videos. If you want to learn more about oil prices or oil drilling or oil project or oil investments or anything above, feel free to call me. If you look below, you could click on a link to request more information, request a brochure, or if you like, please subscribe to this channel. Hope you have a Merry Christmas and a Happy New Year. Thanks.